Well, hello, folks. I'm LA Little, and this is your daily NeoTA wrap. We take a look at these markets, and we do it from a neoclassical perspective each time. We ask ourselves what happened today, and what does it tell us about the coming ones. I do this show 4 times a week, Monday through Thursday, broadcast at or before 10 o'clock Eastern Time. Archived on YouTube, it's under the channel LA Little. You can catch it there anytime, any place, any device. Programming note tomorrow. Today's the 25th. Tomorrow there will be no show. And of course, Thursday no show given Thanksgiving. To all of you, I wish you, happy holidays here. It's that time of the year where we reflect on things, and whether you're overseas or you're here, there's always that time where one should reflect on their good fortune, what isn't working for them. Try to make things better for yourself and for others. That's how we try to improve our society and our lives, and I do take that to heart. As far as these markets, let's take a look at what happened today. So we actually had a mixed market finally, and I don't mean that just in the sense that we had some red on the boards, and we did, and we had it here on the not on the Nasdaq, but on the Russell and the S&P 500. So you had a slight pullback in these two. But what I mean by mixed signals is that we actually had some failures today, which we haven't seen in, 2 weeks, a long time. So that's the thing we'll look at tonight. Everything else pretty much flat. Matter of fact, the whole board was pretty much flat, a little mixed with some up, some down. If you look past that, gold had a little bit of a rally, 0.25% here. We had the bonds actually break out today, up 1 full point, almost 1%. Natural gas got a pop. Oil hammered in front of the OPEC meeting. Of course, you're getting a lot of jockeying in front of it in terms of news. Whether or not that's real or not, what gets that worked out in the meeting. Oil is only going to rally if there's some news of a cut. If there's no cut, they're going to push it again and push it to the downside, right? And we'll try to take a look at a chart there and try to decipher maybe what's coming. But that was pretty much the case today. Let's pop in here and take a look at these indexes, because that, to me, is where the real interest lies. And let me pop over. Well, since I'm here, let's just talk about the dollar. I mean, dollar's fading back in. Remember, it popped out last Friday, fading back in. It's simply in a range here and hasn't gotten out of that range really. So the dollar actually is doing what it needs to do from a bullish point of view, and that is that it's not taking off. It's just kind of holding there. Moving to the equities. This is where we're going to see some of the mixed signals starting to come in. So let's start with the S&P like we always do. The S&P gets over yesterday's high, back underneath it, has more volume. So you would say, okay, it's got more volume, go and test it again. But if you look at Friday, it has less volume than Friday. Remember a big pop-up on Friday off of the twin bank, central bank interventionist type policies that took place Thursday night. 2071.46 was the high there. You got up over it today, back underneath it. A lot less volume, decent amount less volume, and so that's a failure. It's a test failure of Friday's highs. Now, it doesn't mean that we have to fail here, and we know how this market has done, but that is a test failure. In other words, you get up, you don't have any new buyers, you don't have as many, you fall back underneath in terms of price. If we look at the Dow goes sideways. 2 days in a row, dojis. No volume, just sitting there. That gives us no signal other than the fact that it doesn't know what it wants to do. If we look at the NASDAQ gets up and over. Now remember, we had a bad close on Friday. They totally disregarded it yesterday and took it to new highs. They go over, make new highs tonight, has more volume again, and holds over last night's highs. Therefore, this thing can walk higher. That's the mixed signals. So you got NASDAQ, NDX doing the same thing. They can go higher. You got a doji up here. That could go either way tomorrow. But then we go over to the Russell. Now, the Russell, remember there was a swing point high. It's about to drop off the board here. That was 60 bars back. We do 60 bars on the TA Today charts. So 60 bars ago, you had a swing point high. You got over that swing point high on November 12th. You didn't hold it though, right? Got a takeaway bar, the very next bar. That ended up going up, over, back down. That leads to the pullback. Now you come roaring back up there. And what do? You hit that high with slightly less volume. You go over it, back underneath it. That's a test failure at the highs. Now, it's a stronger signal than we just saw with the S&P because it's actually testing a swing point high. That's where you have more information given to you, right, in that sort of a circumstance. If I look at the GSPC again, the S&P 500, yeah, so it fails on the only reason I even point this out is because that had decent volume on it. And you go over it, because that was the Thursday night, Truman Bank action in China and ECB. You get over it, you can't hold it. That's a failure, but it's not as important as this failure, in my opinion, given the reads that I make in the neoclassical style. So that's a test failure at the highs. If by Friday it stays under it, it will be a test failure on the Friday high again. That would be the third one. You can't hang forever. You either got to go up or you got to go down. In other words, you get up here, you can hang for a while, but at some point, one side or the other is going to take over again. And right now, you got the S&P slightly saying, yeah, I might want to pull back. You got the Russell failing again. You got the tech sector still holding. Okay, so that's that scenario. If we look at the world markets, there's only one worth quoting or noting, and that is the German DAX. You do 1.7, you're going into 1.9, you test it, you get over it, back under it, you've had an extended move, that's a failure. That's a failure up there at the highs. This one should try to pull back, and that's what we should be looking for tomorrow. If it doesn't, then it's telling us something different, but that is a test failure at the highs, and amongst the world indexes, that's the only one that really has any huge information release tonight. We did have what may be volume off the top in the Indian market, but it's not huge, and we'll just have to monitor it and see what that one turns out to be. So that's the world markets. Let's pop over, because the other thing worth looking at is the major sectors, right? We've had a few miscellaneous failures on the indexes. In other words, those little signs that we might try to pull back, but you haven't had sector support for that pullback. And if we flip it, I'm going to show you the ones that are starting to set up that they may do that. IBB is trying to get up and test this high. It's coming up there and it has no volume. It actually did an over-under today and may not even test, but if it does test and fell at the highs, that would be a test failure at the highs. IYT, of course, skyrockets again off cheap oil, as oil was down $2. The SOX also over under today. Had a little bit more volume, so it can do it again, but that's a test, over, back under. XLE, we already talked about, pulled off pretty hard today. If I look at the XLI, it goes over and back under. It also has a little bit more volume, so it can try again. XLK, this one actually fails. Just like the S&P, it fails on the Friday bar with a little less volume. That's a test failure of the Friday bar. Let me see. The only other one was XLV. XLV also test failure of the Friday bar. So you can see we're starting to see some of these sectors also showing some wear and tear, a little bit of fray at the edges. Still nothing huge, but it's certainly more than we've seen recently, and makes me think that we're getting close. We're getting close to a potential sustainable sort of pullback that could mark some sort of a short-term top / retrace. And when I'm talking about a retrace, I'm talking about something that's going to last more than a couple of hours. I mean, the only thing we've seen if I pull back in one more time to the S&P 500, the only thing that we've seen over the last 6 weeks now is 1 day down. That's it, folks. 1 day down. This bar, the November 4th bar. Every other bar has essentially been a bar higher. Yeah, we've had some lower closes, but they've essentially made new highs on every bar. There's only one that has failed to do so other than this congestion area, but even those weren't really failures, right? That's the only one. We're going to see 2 or 3 days down at some point. Maybe we're starting to set that up here. Maybe we're not. I don't know. All I can tell you is what signals we are starting to get suggest that maybe this is going to be the time. So not there yet, getting close, potentially getting close, starting to get some signals that are telling us that. So that's kind of the synopsis for tonight. Let me see. Anything else? Oh, I wanted to show you one other thing, and I'll just pop it up this way, is the bonds. The bonds are starting to make their break. So they get over the swing point high, so they'll transition to bullish tomorrow. The big test here on the bonds, of course, will be the bottom of these huge bars. So it will be this little area that you see in red. That's where the test is going to set up. If it can get into this bar, right, then it can certainly test this area, and then eventually maybe test that top. But right now, the test is going to be here. It's not that far away. I suspect we'll probably see that pretty soon, and we'll see if these bonds are going to, tell us something about the market, because typically the bonds, if they start to rally, that's usually not good for equities. It's typically not what you want to see on the equity front. Matter of fact, if you look back here in September, they started to rally. What did the equity markets do? They went the exact opposite. These spiked out on the 15th. Equity markets spiked down on the 15th. Both reversed. Equities, of course, have been straight up since. Bonds have now started putting in this rounded bottom I've been talking about for some time now. And today actually started to move up out of this roundness, right, over the swing point high, and now want to try to test this area. So bonds, that's just worth pointing out, that scenario we were kind of looking at is starting to take place, and that may be a precursor also to some sort of a pullback. Okay, so I had a couple questions. One has to do with the particular stock, so I'll look at that next. And then there's one really kind of a general question which I thought we'd use as kind of the highlight tonight and talk about it a little bit more in depth. So let's take the question first. It has to do with, let me pop it up here. It has to do with Plus. Name of the company, E Plus Inc. Let me pull them up. Here's the charts. And so the question is could I comment on how / if you would trade E Plus from the long side? So this is an IT infrastructure supply chain optimization software firm. That's a mouthful, huh? And the viewer notes that it's had heavy breakouts across all time frames. So I'm pulling those in so you can see it. So you see the nice big breakout here on the monthly. Volume expands. That's great. Top of that, 67 roughly. So let's peg that number in our heads. Go to the next one. Here's the 67 is right here at these lows. So you can see those lows. It comes back, test into those, right? That's the breakout area on the monthly. Test into them the last 2 weeks and can't break them down. So that's the next thing to remember. Now, do note also on this weekly, you went over the highs, back down with a little bit more volume. That's not a good sign. Says that you're probably going to get some sort of a consolidation. So to me, that's the big takeaway when you look at this, is that it's very positive action, but you may have a consolidation starting to take place in this area. This supported by the breakout on the monthly. This, of course, supported by the spike high. Now let's go to the daily. Let me just get that out of the way. I grabbed the wrong thing, so let's go to the daily now. Okay, so now on the daily, here's the gap up area, spike high, volume on that spike. So that particular spike, I think, would have been on a Friday. on a Thursday. So you didn't get, that's why the weeklies turned out like they did. This spike high has not been tested. You didn't test it the next two bars, you come off, there's pretty decent volume. What does that mean to me? Well, that means that this little area right here is kind of the key area in terms of stymieing this price move to the top side or not. In other words, if you get over this, you're probably going to go try to test that high. You know, if you can get over here and stay for a bar, you're probably going to test a high. So that's the first piece of it. The other piece is that if you don't, right, then you can certainly test back into these lows and potentially test all the way back down to the gap. So how do you play something like this? I think the easiest way or the best way to think about it is I would certainly make it tell me that it can get over this price zone and hold it. If it can get up there and hold for a bar, then I might take a smaller position, right, and try to ride it up to here and sell it, or sell most of it. So let's say I would normally buy, let's just throw a number out. Let's say I normally would buy 1,000 shares. Well, in this case, I might just buy 200, you know, at this price point, and try to ride it and sell 150 of them up there. You know, that sort of a thing. I just couldn't put a lot more into it because there's no good place to put a stop, because really your stop should be down here. And if I'm up this high, I have way too much risk. If I put my stop in too close, there's a good chance I get stopped out. In other words, my probability of success goes way down. So why do that? Instead of doing that, just buy less. If you get the move you think you might get as a result of the way it's behaving, then you sell most of it out. Why you sell it out? Well, because you want to book the profits, and if this does break out, there's a pretty good possibility it's going to come right back to there and let you right back in. So there's no reason to keep it. So if you're trading it, you trade it up to there, you sell most of it, and then you let it fade back in, which is the most likely case. It's probably not going to get over that high and hold it. And then as it fades back in, then you pick it up again. Maybe you pick it up in here again, maybe you get it all the way down here. But that's the way I would try to trade the thing. So, you know, when you have something like that that's really strong, it's got a huge move already. And when we're talking about, I mean, think about the numbers here, percentage-wise. You went from roughly 62 to 73. That's a $10 move on a 62 price point. That's what, 15%? Yeah, it's roughly 15%. 15% moves usually are going to get faded. That's what's happened. And they're usually going to get tested again. And that's what you're trying to trade. At the same time, a 15% move can give up half. Well, where would half be? Well, half would be all the way back down to here somewhere, 66. You know, so 65 maybe. You know, what was the number here again? 62 to 73. So that's roughly 5.5, 62, 67.5. Hey, that's interesting. It went to 67.5, right? That is that price point. That's exactly where it traded here. So anyway, that's the way I try to trade it. All right, let me pop over to the other question. It's kind of an interesting question, and it has to do with credit spreads. And let me get this set up so we can look at these together and make sense of them. As a matter of fact, let me do this. Let me get rid of the volume and only look at these. Okay, so I'm going to start off by just reviewing what this is and what the viewer is asking, and then we can come back and look at some of the other things I was looking at right before I came on. So if I pull this in to, say, just a month, and if we take in first of all, let's talk about what a credit spread is. Basically, a credit spread is the difference in yield between two bonds of some, you know, similar maturity but different credit quality. And one of the common ones is basically junk bonds to government bonds. And in this case, JNK is a junk bond, which is represented in this picture by the blue line, which is here. TLT is the black line, and this is, I threw the S&P 500 on here. So we can actually take this one out so we can see the credit spread better. And so what the viewer says is, hey, I've been noticing that since November 12th, which is right here, right? Basically the 11th was the high on the junk. Since that time, you know, these spreads have been widening. And so what does it mean for these to widen? Well, if you think about it, junk bonds are a lot more risky than government bonds. So if junk bond yields, if the value that they have begins to fall, you know, then that's saying that there's more risk in the market. And so, you know, a lot of folks, a lot of, you know, analysts look at this and say, okay, when I see a yield begin to spread, where the spread between these two is different, then, you know, maybe there's more risk in the market. Maybe that's a precursor to a market drop. So that's the idea. So the question to me that was being asked is, what are my thoughts? You know, when I look at this chart, you know, does this tell me anything? And I'd have to, you know, back this chart up to really try to explain why I think it doesn't. And so let me do that. So let me go back to, let me just put it on 10 years so that I can get most of it. Let me pull it in from where the junk bonds started trading at. This was the debacle, right? So it's too bad junk didn't go back. That ETF didn't exist a little bit earlier. We could have seen the difference. But you can see how bonds, government bonds, spike higher, whereas junk bonds, which are, you know, think about it. Junk bond is saying that the bond's only good if that company exists. In other words, if it goes out of business, I'm going to lose everything. That's what makes it junk. And they pay a lot more interest as a result, you know, for the risk that you take. Well, that relationship would be like this in a crash, which is what you saw. Now, as the crash recovered, junk bonds recovered, bonds come down. That's the normal relationship you would expect to see. But then if you follow this up, you know, and now I'm going to put the S&P 500 on here. If you follow this up and you look at the S&P 500 as the overlay, which is the green, let me pull this back in now. As the S&P 500 begins to recover, right, junk bonds are recovering and bonds sell down. That's the normal relationship you would expect. But then, you know, here you go with TLT rising, pull back in the equity markets, pull back in the junk markets. That's that spread, but it's not a precursor. It actually happens as a result of the market selling off, or at least they all do it simultaneously. So it's not really a precursor to what's happening when we're looking at it on this time frame. If I move over to the next time the S&P sells off, what do we see there? Well, in that case, it kind of supports what was being asked, and that is that the TLT starts rising, the spread widens, right? And these start to sell down. And as a result of that, you end up seeing, you know, not as a result, but coincident with that, you see that spread widening about the same time. But, you know, notice here that TLT actually started up almost the same time that the S&P's topped out. So fast forward to the next one, and you get the picture here. As the TLT rises, it seems to rise almost simultaneously with the sell-off in equities. You know, I mean, there's very little lead time, if you will. And the junk bonds almost always sell off right along with the equities, almost always. So that relationship that you're looking for is a precursor. You know, it's hard to see it on this time frame. So this is like, let's take the last time we had a good correction, which was for April of 2011. I'm going to pull this in, put it on a daily, and I'm going to pull in just that piece of it. And pull it in a little tighter so we can see it here, right? So we're only looking at, okay, so equities topped here. This was the top. Okay, so what did bonds do? Bonds were going up as equities came down. That spread started to, you know, to come the other way on the junk bonds. But again, you can see here, there's not much in the way of lead time. And The big move down here is the big move up there, and the big move down here. So they're going almost coincident with each other. So my point is, you don't, and I hadn't looked at this in detail, so I thank you for asking the question, but the point is that you really don't see much in the way of lead time on that relationship. So that's kind of the first thing. The other thing to realize is that this whole relationship is whacked to start with, right? And if I put it back on the monthly, and if I take junk bonds out and just the TLT now, along with the market, right? Usually you're going to see, with this kind of a rise, you're going to see the S&P eventually overtake, just like you see it back here. You're going to see the S&P overtake early in the rally, or somewhat early in the rally, right? You're going to see it overtake the bonds. That's the normal relationship. In other words, bonds, here, look at it this way. Go back to some period before we had QE, which we have here. Look at this relationship. As equities make new highs, TLT makes new lows. That's a more normal relationship. As the equities top out here, you can see the difference in the TLT starting to rise, right? And then eventually you get, the crash. That relationship is a precursor to a downturn in the markets. And so that's what you'd normally see. Okay, now fast forward to the world after QE. What do you see here? You see a steady rise time after time. You did see a pullback here, but here you are again at the tops. A steady rise time after time in bonds, coincident with a huge continual streaming move higher in equities. In other words, they're both going up. You were trying to pull back here while these go up, which is the more normal situation. But here we go again. Bonds flat out flying to the roof again, along with equities. That's not normal. That's what I'm talking about when I'm talking about, these relationships are whacked. And so with a whacked relationship, it's hard to put any kind of correlation together on them. And so I don't even try anymore, other than to note when bonds start rallying, stocks usually don't do so good. And that's the only relationship that still seems to be in effect, and you can see that time after time in this chart for the most part. Why is that? Well, government bonds just simply don't float freely anymore. You have a lot of intervention, artificial demand as a result of central bankers around the world. You also have currency wars that are taking place that's driving money into our markets, and in a sense is going to drive them into equities. It's going to pull them closer, farther and farther into equities. Excuse me there. And so that piece of it is also supporting the TLT and whacking this relationship. And so, given all those things, it's hard for me to use these relationships that have existed for a long time in this new QE world we live in. And that's what makes, that's what makes it so hard to stay with these equities, because you don't have a lot of things that you can base it on anymore. A lot of these relationships one would normally look at, you can't look at anymore. Those relationships are out of kilter, and it's just the way it is as long as we got all this QE and we got currency wars. And so in a long-winded way, no, I can't really use that. I don't see a way to use that, a productive way, as a precursor to a pullback in equities. The best precursor we have is what you see me doing all the time, and that is that I'm saying, okay, this is what should happen, right? And I look at it, and here's a weekly. I look at it and I say, okay, this should continue higher. When it doesn't continue higher any longer and we get a failure, like potentially a failure on the weekly here, if you get a failure here and you get a failure over on the daily, then I've got something that tells me, hey, maybe we're going to pull back finally. And I use that as my key versus these other interrelationships. Hopefully that answers your question. Folks, I'm a little long-winded tonight. Again, no show tomorrow. Of course, no show on Thanksgiving night. I will pick it back up with you on Sunday. Have a great holiday season. Enjoy family and friends. Until next time, I'm LA. And this was your daily Neo wrap. Have yourself a great one, folks. Take care. Be careful. Good night.